Welcome to the Deep Dive. We're here to break down complex info into insights you can actually use.
And today, yeah, we're diving into tax deductions for the self-employed. It's constantly changing, and there's this big new law, the One Big Beautiful Bill Act, the BBB Act, signed July 4th, 2025. That's our focus.
Right. Our mission, pull out the key stuff on the home office deduction, the QBI deduction, and all those vehicle expenses.
And crucially, how they all link up, because that's where the real strategy is. You might be surprised by some of them.
Okay, let's jump in. Home office deduction, what are the absolute must-knows?
Okay, so the core requirements haven't really changed. You need a space used exclusively and regularly for business. That's key.
Exclusively, so no mixing personal stuff in that exact spot.
Exactly. And usually it has to be your principal place of business, but there's a really important safe harbor.
Oh.
If you use the space for, say, administrative or management tasks,
Yeah.
and you genuinely don't have any other fixed spot to do that work, it still qualifies, even if you do your main work elsewhere, like at client sites.
That's huge. Because having that qualifying home office, it's like the gateway, isn't it?
It really is. It's the strategic piece, because that's what turns your drive from home to a client site from personal commute.
Which you can't deduct.
Right, into deductible business mileage. And that mileage unlocks the big vehicle depreciation deductions we'll talk about. It all starts there.
Gotcha. And calculating it. There are options, right?
Yep, two main ways. The actual expense method is detailed. You track actual costs, like mortgage interest, utilities, repairs, proportion to the office space, plus depreciation.
Which means you might have to pay some tax back later if you sell the house, the recapture tax.
Exactly. Or there's the simplified option. Much easier. It's just $5 per square foot of office space, but it's capped at 300 square feet, so a max deduction of $1,500.
And no depreciation recapture with that one.
Correct. So it's simpler, less record keeping, no recapture worries, but potentially a smaller deduction than tracking actual expenses. Your choice really impacts things down the line.
Okay, so the home office unlocks business mileage. Let's follow that thread to the vehicles. The BBB Act seems to have shaken things up there quite a bit.
Oh, absolutely. Section 179, for instance, that lets you expense the entire cost of qualifying property like a business vehicle in the year you buy it instead of depreciating over time.
And the limits on that went way up.
Way up. For tax years after 2024, the BBB Act pushes the max Section 179 deduction to $2.5 million. The phase-out threshold also jumped to $4 million in total equipment purchases. Massive potential for immediate write-offs.
Wow. Okay, and then there's bonus depreciation. How's that different?
Bonus depreciation is also a first-year write-off, but it's handled a bit differently. Unlike Section 179, it can create or increase a business loss. And the big news with the BBB Act.
This is the whiplash part.
Exactly. The Act temporarily brings back 100% bonus depreciation, but only for property acquired and placed in service after January 19, 2025 and before January 4, 2030.
So if you bought something big in late 2024, you might only get 60% bonus, but wait until early 2025. Boom, 100%.
Precisely. It creates this incentive to maybe delay significant purchases just a little bit into 2025 to capture that full 100% deduction. Think about buying a heavy SUV or truck for your business.
Right, the heavy vehicle thing. Over 6,000 pounds gross vehicle weight rating?
Those vehicles aren't subject to the lower depreciation limits that apply to regular passenger cars, those so-called luxury auto limits. So you can often deduct more, faster. Though, important note, heavy SUVs do have their own specific Section 179 limit. It's $31,300 for 2025. But you can still potentially take bonus depreciation on top of that.
Okay, lots of opportunity there. But there's a catch with a new loan interest rule in the BBB Act, right?
Yes, this is crucial. The Act created a temporary no tax on car loan interest deduction. Sounds great, but listen closely. This is only for interest on loans for personal use vehicles.
Not business vehicles.
Absolutely not business vehicles. You still deduct business vehicle interest as a regular business expense. Don't get those mixed up. It's a common point of confusion already.
Good flag. And one more, complexity state taxes.
Yeah, always check your state. Many states just don't follow the federal rules on accelerated depreciation like 100% bonus or high Section 179 limits. So you might get a big deduction federally, but have to add it back on your state return, paying state tax now and getting the benefits spread over years. It's like a hidden tax, or at least a timing difference.
Okay, let's shift gears to the qualified business income, or QBI deduction. This affects a lot of self-employed folks and small business owners.
Huge impact. It basically lets owners of pass-through businesses, that's your sole props, partnerships, S-Corp, deduct a chunk of their business income right off the top.
And the BBB Act made some major positive changes here.
Two big ones. First, it made the QBI deduction permanent. It was set to expire, creating a lot of uncertainty. Now it's here to stay.
That's massive for planning.
Huge. And second, it actually enhanced the rate. For tax years starting after December 31st, 2025, the deduction goes from 20% up to 23% of qualified business income.
So more permanent and a bigger deduction. But how does it interact with those other deductions we talked about, like home office and vehicle expenses?
The ripple effect. Your QBI is calculated after you take most other business deductions. So claiming a big vehicle deduction using bonus depreciation, for example, reduces your overall taxable income, which is great.
Not bad.
But it also reduces the income base used to figure your QBI deduction. So the bigger your other deductions, the slightly smaller your QBI deduction might be. It's a trade-off, part of the overall calculation.
Makes sense. Now, what about the dreaded SSTB limitation, specified service trades or businesses?
Right. This is the challenge for folks in fields like health, law, accounting, consulting, athletics, certain service providers. If your taxable income goes above certain thresholds, your QBI deduction gets limited or even disappears completely. It's kind of a cliff.
What are the numbers for 2025?
For 2025, the limitation starts to phase in for SSTBs when taxable income hits $197,301 for single filers, and it's completely phased out by $247,300. Double those for married filing jointly.
So if you're an SSTB owner making good money, you might lose out on that 23% QBI deduction.
You might. But there's a common strategy, especially if you're nearing or over those thresholds.
The S Corp.
Exactly. Electing to be taxed as an S Corp allows you to pay yourself a reasonable salary. That salary is W-2 wages. The QBI deduction has another limitation based on W-2 wages or the basis of business assets. By paying yourself that salary, you create a W-2 wage base,
Which can then allow you to claim the QBI deduction on the remaining business profits passed through to you.
Precisely. It's a way to potentially unlock the QBI deduction even if you're a high-income SSTB. Requires careful planning and running payroll, but it can be very effective.
Okay, so pulling this all together, it's clear these deductions aren't just separate boxes to check, they're interconnected.
Absolutely. Your home office enables vehicle deductions. Those vehicle deductions, along with others, impact your QBI calculation. It's a whole system. Understanding those connections is key to maximizing your savings.
And remember that depreciation recapture risk, especially with vehicles, if your business use drops below 50% or you sell it too soon after taking big write-offs.
You could owe some of that tax benefit back. Definitely something to keep in mind with aggressive depreciation strategies like 100% bonus.
So the final thought here, we've got this new landscape thanks to the BBB Act. A permanent boosted QBI deduction, 100% bonus depreciation back temporarily, huge opportunities.
The question for you, the listener, is how are you going to adapt? How will you strategically position your business decisions, your purchases in 2025 and the years ahead to really take advantage of these powerful tax benefits? It requires planning, but the potential savings are significant.